Okay. Welcome to the JDC West 2020 Finance Case Competition sponsored by RBC. Thank you to our judges Tay Kim, Randy Walwin, Tracy Code, Siraj Patel, and Nicole Drysdale. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask the presenters questions. Competitors, you will see Zoom chat notifications at various intervals to indicate the remaining time. Any speaker who continues to speak after the maximum time limit will be stopped. No questions or comments will be permitted from the audience. All judges are asked to have their microphones muted during the presentation. The audience is banned from any material or naming convention that bears the name or symbol of a competing university. We ask that the audience leave the Zoom call immediately following the presentation. Judges, please stay on this call until I advise you to move on to the next call. Competitors, you may begin your presentation.
You can't build a great building on a weak foundation. So why would you risk it with your business? Good morning, Engineered Assemblies team. My name's Luke, and I'm joined today by my colleagues Caroline and Ravneet. And today we are so excited to present to you our ABC strategy, which we believe is the foundation for a successful future at Engineered Assemblies in terms of operations and strategic success. So the question we asked ourselves today is, should you acquire RTS Design? And also, how can you address management's current concerns? So we analyzed the current issues you're facing, some of the trends in the industry and how they affect you. We have evaluated the different alternatives available to you in terms of capital expenditure. And we also analyzed the strategic fit of RTS Design as an acquisition target. For our financial analysis, we conducted a discounted cash flow valuation of RTS to arrive at a purchase price. And that led us to our ABC recommendation: acquire RTS Design, buy a new fleet of trucks, and make operational changes to satisfy management concerns. And the impact of this is that you will realize $260,000 in acquisition synergies and construct the foundation for a strong operational future. Now, let's dive into the analysis. So, first, looking at the current issues, we've divided them into 3 categories: those around the acquisition of RTS, those around capital expenditure, and around the cash flow concerns. So the main issue of the RTS acquisition is you're unsure if you should acquire them. They would boost your installation praxi revenues, but there is a bit of risk that their financials could be under allocating some fixed costs from their parent company. And you also would have to lay off your own staff in order to achieve those economies of scale from the acquisition. There's also a bit of a mismatch between the pricing that they're asking and the financing you have available. So we believe that RTS should be acquired, but at a discount due to its questionable financials and staffing issues that will arise from the acquisition. In terms of capital expenditure, your truck fleet needs to be repaired or replaced, and the current repair downtime is leading to scheduling setbacks. Also, the lack of a clear dividend policy makes capital expenditure planning quite difficult. And now you're left with 3 options for your fleet: repair, buy, or lease. And we think that the chosen option should minimize downtime and be feasible given an updated dividend policy. Now, in terms of cash flow, the issue is that you're experiencing regular cash crunches. The inflow and outflow of cash on large contracts is leading to a timing difference. And that's really causing a cash crunch each time those contracts come through. There's also an increased interest expense from an acquisition capital expenditure, and you have to comply with the debt covenants that your bank has laid out, which is at least at minimum a quarterly principal payment. So our proposed solution must keep your cash balance positive and comply with those debt covenants. So let's look at the industry trends and how they affect you. We're currently seeing high levels of consolidation and competition in the construction supply industry. So companies looking to stay in the industry like yourself should achieve economies of scale now in order to stay competitive. We're also expecting rate increases from the Bank of Canada in 2022. So companies that are taking on leverage in order to expand should have sufficient cash flow in order to absorb those rate increases. We're also expecting a 4.7% CAGR in the construction industry over the next 5 years. So we believe that companies should pursue their growth strategies now in order to fully capitalize on that industry upswing over the next 5 years. And lastly, growth in the green building supply space is actually expected to outpace the overall industry average of regular construction supplies. And that's really good for you because you're currently positioned to outperform your peers because of your green product offerings. So we believe that you're well positioned due to your product offerings, but achieving those economies of scale via an acquisition would further increase your growth, as long as that increased leverage wouldn't lead you to a cash crunch. So now let's look at the strategic fit of RTS design and why it would be a good fit for you to acquire. So in terms of operations, it will help increase your installation market share. And by combining with a company that is in a similar line of business, you'll achieve some cost saving economies of scale. So overall, we think that the RTS acquisition will help you stay in line with industry consolidation trends. Also, RTS has built a really strong relationship with their customers and within the industry. And that customer list includes a lot of contractors you haven't built relationships with yet. And that could really help boost both Praxi and engineered assemblies revenues, because not only will those new contacts need installation services, but they might buy products directly from you to install themselves. Now, there are some concerns with RTS. There's been the potential, they potentially use kickbacks in order to win large contracts. And there is also potentially understated expenses on their income statement. There's also a severance clause that requires you to retain their employees for at least 1 year after buying them, or offer them a severance package. But we believe that despite these potential concerns, RTS is an excellent acquisition target that will help grow your customer base, market share, and keep you in line with the industry consolidation trends. Now, you also have a few capital expenditure projects that you need to undertake, namely how to replace your aging truck fleet. So the options are either to repair and buy a new fleet, lease and then buy out the lease at the end of the term, lease and then buy a new fleet, or just buy a new fleet outright. So we evaluated this first in terms of net present value, and we just did that free cash flow for the project, and leasing and buying out and buying new were the only ones to have a positive net present value. We also wanted to take advantage of the high demand for used cars. Right now, you're able to sell your aging vehicles for a premium, and you want to try and take advantage of that premium if you can. So all the options do this except for repairing. We also want to make sure that you're able to take annual depreciation, which you're only able to do if you own the asset. And we also wanted to make sure that there wasn't any schedule disruptions from repairs, which everything does except for the repairing option. Lastly, we wanted to make sure the project is feasible given our proposed dividend policy. And again, all the options do fit with that except for repairing. So overall, repairing the fleet has a negative net present value and doesn't capitalize on current demand in the used car market. And then leasing and then buying out the lease actually decreases your free cash flow because the assets are not depreciable while they're being leased. Next, leasing and then buying a new fleet has a negative net present value because those free cash flow benefits are too far into the future in terms of the asset's useful life. And that leaves us with buying a new fleet. We believe that buying a fleet outright has the highest net present value of all the options because those free cash flow benefits from the salvage value, depreciation, and interest tax shield are front loaded in the asset's useful life. So now that I've explained why we want to go with these recommendations, I'm so excited to pass it off to my colleague Caroline, and she's going to walk you through the numbers behind them.
Thanks, Luke. Now I'll be walking through our financial analysis where we've conducted a DCF valuation on your potential acquisition target RTS design. So first, let's take a look at our valuation assumptions, where for historical revenue growth, 2020 has suffered from pandemic-driven economic slowdown, where the industry has shown and investment in new construction has grown in the industry in 2021, where revenue growth picked up. So for revenue growth assumptions going forward, given the industry is closely tied to the economy, given its cyclical nature, as well as historically the industry has experienced a mid-single digit revenue growth for a normalized industry level, we've forecasted a base case of 6% revenue growth, as well as a bear case of 2% and a bull case of 10%. So let's take a look at the rest of our assumptions for our operating model. For tax rate, we've kept it consistent with historical of a corporate tax rate of 30%. And for expenses, so we want to make a conservative assumption to account for the risks of potential historical under-allocated fixed costs, where we've assumed expenses of 30% as a percentage of revenue, where compared to historically is 25%. So moving on, based on our assumptions, here are our operating model for base case, and that gives us a EBITDA margin of 20%, as well as a profit margin of 11.1%. Moving on, looking at our DCF valuation, we first used a Gordon growth model where we've used a perpetuity growth rate of 1.5%, which is given by management guidance, as well as it's in line with Canadian long-term GDP growth. For our second method, we used a exit EBITDA multiple where based on present transactions in the construction industry, we've used a multiple of 5 times. Moving on, for our DCF valuation, we've also used a weighted average cost of capital of 15%, which is in line with management guidance as well. So moving forward, we've also conducted a sensitivity analysis based on the difference in WACC as well as a terminal growth rate. So looking at the middle part of our sensitivity analysis, given a plus minus 0.5% on both rates, we can see that our valuation in the base case scenario ranges from 2.3 million to 2.5 million. And here's the valuation summary, where given our base case scenario, it gives us a valuation of 2.1%, a bear case of 2.1%, base case of 2.5%, and bull case of 2.5 million. So with every acquisition, there's always a synergy that you're looking for when you're acquiring a company. For our assumptions, we've assumed a 3% target company's revenue as our cost synergies, and that 3% is the medium level of historical successfully captured synergies in the construction industry, where it gives us a final purchase value of 2.7 million for RTS acquisition. Now I'm so excited to move on to our recommendation, which is our AVC strategy. So first, let's start with acquire. To acquire the Canadian division of our RTS design with a purchase price of 2.7 gives you the diversifying portfolio of customers as well as increased market power. And we've also listed out some of the recommendations going forward to accelerate the integration process, including establish a value protection team to manage risks, as well as pursue cost savings, and launch a client relations team to manage your increased client base. So moving forward, here's the acquisition process, where you would first, in the preliminary stage, establish EA's investor strategy, as well as negotiating your letter of intent, offer letter, and due diligence analysis, as well as adjustments accordingly. And with that, the closing of the transaction includes signature of the agreement as well as payout. Moving on to the terms and conditions of the acquisition. So your acquisition will be financed by first a cash down payment of Canadian 200,000, which is 8% of the purchase value that we've analyzed, as well as the remaining 92% will be paid through a bank debt financing for Canadian dollar 2.5 million at 7.5% for a 5-year term. Moving forward, here are some of the other transaction considerations that we've looked at, where first of all, RTC has asked you to keep all their staff employed for at least 1 year, as well as there's a potential risk of RTC's potential involvement in providing kickbacks to general contractors. For these two specific consideration, we recommend that for employees, you would implement a co-working solution for RTS employees that you will be acquiring to belong after you launch the value creation team, as well as the client relationship team that we've recommended before. And for the potential kickback activities that they previously involved, so offering kickbacks is unethical, and as it hinders a general contractor's ability to make an unbiased decision. So we recommend you do not associate with any activities related to giving out kickbacks. And now I'm so excited to pass it on to my colleague Rami to go over the rest of our ABC strategy.
Thank you, Caroline. So now I'll be talking about the second pillar of our recommendation, which is B for buy. So should engineered assemblies repair their trucks, buy new ones, or lease? We've determined that they should buy new trucks because the cumulative free cash flow of this option outpaces the other options. So the outcome is that the new fleet is operational and ready to support increased operations post the transaction closing. And now we'll also take a look at the financial impact of buying a new fleet. So the positive net present value of this project is $55,000 more than the next best option, which was to lease and then buy out at the end of the lease. And this will also ensure that your regular payments comply with debt covenants. And with that, we'll move into the third pillar of our ABC strategy, which is C for change. So how can engineered assemblies manage all of its stakeholder considerations? So we had several smaller issues that management has asked us to address. And while it might seem overwhelming if you are unsure where to begin, we have provided it to you in a more digestible way by looking at 4 key focus areas. So customers, shareholders, suppliers, and the community. So let's dive right into it. Starting with customers. So how will we manage cash flows from our customer payments? Well, firstly, a large customer is experiencing cost overruns and has asked your company to shift its invoice to another project. And we do not recommend distorting project costs for your clients. And secondly, EA currently provides favorable terms to large customers to be able to close transactions. So our proposed strategies result in a positive cash flow, and we modeled this. And if you take a look at the ending cash balance, you see that our strategy does meet the debt covenants. And we also recommend implementing a 30% policy if a client backs out of a contract to help mitigate some of that timing difference and cash flow risk. Now we'll also take a look at developing a dividend payout policy for shareholders. And this is because the current policy causes difficulty in planning capital expenditures. So the type of policy we recommend is a stable dividend policy where the percentage of profits that are paid to shareholders is fixed at 10%. And in the dividend declarement process, it's important that the CFO is the one to notify shareholders to ensure that messaging across the organization is consistent. So the outcome of this is stabilized cash flow. Shareholders will receive regular dividend payments and a more efficient use of the company's capital expenditure. We'll move in now to reducing FX risk as a small business. So the market is currently expecting the Canadian dollar to depreciate relative to the euro over the next 5 years, and this is based on market estimates. So what does this mean for your business? If we take a look at a contract size of $1 million, if you entered at today's spot rate, and we looked at various time horizons to see what would be your FX loss exposure, we see that the maximum you could lose over the next year is in the 12-month term of $22,000. And we think that this is lower than the cost of hedging via forwards or futures. So what can you do? We recommend adding protection to your existing contracts to mitigate the risk of a large FX deviation. So this will include having a clause in your contracts with suppliers where if the base exchange rate fluctuates by more than 2%, the parties in good faith will negotiate a possible exchange rate compensation. And this will allow both sides to budget for foreign exchange exposure and increase their visibility as to how much they are at risk of losing. So the outcome is your controlled volatility is plus or minus 2% of your contract size. And now we'll also take a look at charitable organizations. So EA is currently taking a look at possibly supporting the Canadian Association of Women in Construction, and we recommend going forward with this. And we took a look at the current sponsors, and we see that there are currently a lot of industry leaders that are supporting the business. And the sponsorship package that we recommend is at the gold level. And the reason why we recommend doing this is firstly, the human advantage does not discriminate. We think women are an integral part of the labor force, and EA can contribute to increasing representation in the construction industry, as well as since your current sponsors have partnered up with this organization before, you're competing for skilled labor. So these sponsors currently have access to the organization's pool of great talent. And lastly, you will also be providing financial support for a great organization. Now we'll take a look at the implementation. So what should EA do immediately? Firstly, to acquire RTS design, your acquisition team will meet with senior executives to propose the acquisition. For purchasing the new trucks, you will immediately list your existing fleet for sale and begin to search for new fleet suppliers. And in managing stakeholders, you will begin to draft your new policies. Looking at it from a closer lens, we see that the milestones in 2022 include winning the bid, announcing the transaction at the end of Q3, and obtaining the bank loan. And some KPIs are that you'll have 6 to 9 months and execute the transaction at $2.7 million. And for this one, we see that the policy is completed in Q2, and it will take around 3 to 4 months. So with any great strategy, we do have to account for risks. So the most significant risk that we have identified is that a large customer backs out of a contract. We think the probability of this is moderate due to your close relationships, but the severity would be high. So the strategy we recommend is to increase the penalty amount to 50% on contracts greater than $2 million. So at the beginning of this, we reflected on the quote that you can't build a good building without a strong foundation. And we believe through analyzing our current issues, as well as recommending our ABC strategy, your organization will be able to construct the foundation for a strong operational future. Thank you, and we now open the floor to any questions.
Yeah, Nicole, you could go ahead.
Thank you. I'm wondering if one of your options was to purchase the vehicles. I'm wondering, with COVID causing such delay on getting new vehicles, did you factor in that time and the potential repairs that could be required in the immediate needs?
Yeah, absolutely. So when we were looking at purchasing them, we felt that it was like the trucks had already been made available because the financing was available, excuse me, through the dealership. So we felt that being able to purchase them immediately was feasible, and that way we wouldn't need to have the downtime with our schedule associated with the repairs, as well as the additional costs of renting the trucks while those repairs are going on.
Thank you.
Yeah, T, you could go ahead.
Thanks for the great presentation. It was very concise and very focused. So just a quick question on the consolidating the RTS and Praxi business. Do you guys have any concerns of when you're combining businesses, are there any cons to it in terms of organization, or, there could be a synergy, but there could be some downturns?
Yeah, for sure. If we could go back to the acquire slide, first one. Yeah. And so basically for our, for every acquisition, there's always a period for integration. If you could move to the next slide. So what we recommended here is to establish a value protection team, which you can track and monitor the key business processes to mitigate potential risks that when you're integrating the business, as well as pursue cost savings to, for example, reduce workspace overlap, as well as a different cost savings for support functions, and as well as launch a client relationship team to evaluate cross-selling opportunities for both companies. So these are recommendations that strategies that we recommend to address the potential risks for the integration of the business.
Thank you.
Randy, you could go ahead. Actually, you're muted.
Sorry about that. I didn't see any mention of the option of moving into a larger facility. Was that considered at all in your analysis?
It was considered, but we have identified that the more immediate concerns of your business would be the dividend payment policy, as well as the suppliers, as that is affecting your business now. And we considered the moving into the new facility as more of a long-term consideration.
Thank you.
Tracy, you could go ahead now.
On the foreign exchange side, the recommendation was to go back to the companies that you're dealing with and build in some kind of trigger into those contracts. In some cases that will work, in some cases it won't work. Have you thought of how you're going to compare pricing on bids when you have some companies that will allow you to move that number and some that will not, both for customers and for suppliers?
We are confident in our strategy as we believe that it's mutually beneficial. So as much as we would benefit from our FX losses, it also mitigates that if the Canadian dollar does appreciate relative to the euro or any other currency that we're dealing with, then our customer or supplier would be at a loss in that case. So it also minimizes the risk for them. And we think that would increase the probability of them accepting this recommendation.
Any other questions? We still have like a minute left. Yeah, Nicole, you could go ahead.
I just have one more question. I didn't see an option of buying out the brother Paul, and I'm wondering if that was taken into consideration, considering we're taking on new debt, which may affect future dividends.
We did consider the option of buying out Paul as well, and we recommend not to buy out Paul, as we think that Paul does add value to the organization from a lawyer perspective, as well as that even if we do buy him out, that will not prevent him from sharing his opinion, and as he is your brother. And we think that with the 5% ownership, that he's not a majority shareholder, so we don't think that it is an immediate threat.
Yeah, T, you could go ahead.
Sorry, just building onto that, was that discussed during the presentation?
It was not discussed during the presentation, but we did consider it when formulating our recommendation.
Awesome. Thank you.
Okay, so that concludes the Q&A session. Thank you, delegates, for presenting today.
Thank you
Thank
so
you
much.
for your time, judges.
Yeah, thank you for your time, everybody.
Thank you.